As previously discussed, financial institutions like banks play a critical function as information traders in the national economy. To recap, efficient financial markets channel funds from households, firms, and the government, and in practice also foreigners, to those who demand such funds and have the ability to repay, including compensation such as interest. Since this exchange is not immediate, it is characterized by a high degree of incomplete and asymmetric information. Who is the most creditworthy and trustful borrower? Which firms issue the most profitable stock? And so forth. Financial intermediaries are a central aggregator of such information and provide it as a service to their clients. The importance of banks, mutual funds, or insurance companies in financial exchange can thus not be overstated. They remain the most common form of financial exchange even in the most highly developed financial markets. In the following, we will discuss a brief overview of financial intermediaries, with the caveat that financial innovation often renders categorizations obsolete quickly. Some firms, for instance, unite several types of financial intermediation within the same house. The list is also far from comprehensive. Traditionally, there are financial institutions which facilitate the direct exchange of finance, but are not strictly speaking financial intermediaries. All they do is bring together the final parties involved in the exchange. This includes brokers, dealers, and traditionally at least, investment banks. Financial intermediaries, meanwhile, are defined by what is referred to as asset transformation. And we will discuss in a moment what is meant by that. Now, to clarify the first three categories, brokers do not actively make investment decisions. Rather, they match buyers and sellers of an asset and are paid on commission. In such, they do not take position in the assets they trade, which means they do not hold inventories. Examples are, for instance, stockbrokers. Dealers also do not actively make investment decisions. The main difference to a broker, however, is that a dealer will take position. That means they will hold inventories. Dealers buy at a lower price, the so-called bid price, and sell at a higher price, the so-called ask price, and make a profit of the difference. Examples are real estate or bond dealers. Investment banks, by contrast, are more complex creatures. Their origin was financial regulation passed after the Great Depression in the 1940s, and their original function was to assist in the initial public offering of bonds or stock, so-called IPOs. In such, they take on a variety of consulting or sales assistance functions for their clients, and importantly underwrite new assets, which means they guarantee a fixed amount of funds raised from the initial sale of a new asset. Within the IPO, however, an investment bank does not actively make a financial investment decision, which is why, traditionally speaking, investment banks were not considered financial intermediaries. However, at least since the 1970s, investment banks have taken on additional roles. They're already allowed to make market, which means they can trade in the assets they're offering, because they need to get a sense of the price they can score in an initial public offering. As a consequence, over the decades, investment banks increasingly have taken on the form of mutual funds, raising assets from their clients, raising funding from their clients, through, for instance, short-term money market mutual funds, and then investing them in all sorts of risky activities, such as, for instance, the stock market. Such activities are considered financial intermediation, since investment banks herein choose portfolios. While prior to the Great Recession of 2008, 5 large US investment banks existed, all of them now have either been absorbed by traditional banks, such as, for instance, Bank of America, who absorbed investment bank Merrill Lynch, or they now act as bank holding companies like, for instance, Morgan Stanley or Goldman Sachs. Switching to financial intermediaries, a financial intermediary in its easiest terms is an entity that raises funds in one financial exchange and then uses those funds in another financial exchange. This often entails transformation of risk and maturity, a process referred to as asset transformation. For instance, a bank may raise funds from many depositors through rather short-term checkable deposits or certificates of deposits, and then use these pooled funds to issue much more long-term mortgages or similar loans. That's what asset transformation means. It's an example of that. Now, as a reminder, there are benefits to this. For one, financial intermediaries reduce transaction costs, they provide liquidity, they benefit risk sharing, and centrally to mitigate asymmetric information problems. The first such problem is adverse selection, which is a problem that occurs before a contract is made. For instance, many individuals may apply for a loan with the bank. Not all of them are equally good borrowers. Now, borrowers themselves have a better understanding of their creditworthiness and their willingness to repay than a bank does. Now, for any given interest rate, reflecting, say, an average risk of borrowers, more risky borrowers are more likely to apply for a loan. This is a process referred to as adverse selection. Banks, through screening measures, are institutions that really in a very central way screen borrowers to assess their creditworthiness and distribute loans accordingly. And that's the adverse selection problem. Moral hazard, by contrast, is a form of asymmetric information that occurs after a transaction is made. Usually it involves a principal who assigns a task to an agent who then cannot observe if the agent is actually acting in the interest of the principal. One example of this is a lender might provide a loan for a certain investment purpose, and the borrower then might use that investment for a much more risky asset or might embezzle the funds. This type of problem is referred to as moral hazard. And again, banks screen and monitor their borrower behavior in an effort to ascertain better functioning of borrowing and lending. That's the critical role financial intermediaries really play in this. Now, in terms of the types and classes of financial intermediaries there are, in practice there are many, but broadly we can break this down into three different sets. The first one are so-called depository institutions, like banks or credit unions, which raise funds through deposits, hence the name, which they then transform into loans, with mortgages being the largest category. Contractual saving institutions, as the second category, acquire funds through periodic fees and invest often in safe assets like, for instance, government bonds. Insurance and pension funds are the most important players in this segment. Finally, investment intermediaries fund other types of often riskier activities. They're a bit of a catch-all category. And this includes firms like finance companies, mutual funds, or hedge funds, which often have idiosyncratic funding and investment models. Final point on financial intermediaries. While few experts question the importance of financial exchange in principle, it is important to point out that financial intermediation does not completely fix asymmetric information problems associated with financial exchange. Rather, they transform one informational asymmetry into two informational asymmetries. One between the intermediary and the ultimate receiver of funds. This one presumably improved thanks to the presence of the intermediary, but there's also another one between the original provider of funds and the intermediary itself, for instance, the depositor that provides funds to the banks. It is less clear that the intermediary automatically acts in the interest of the original provider. As a case in point, excessive risk-taking in arcane financial instruments after 2000 by banks and other players put millions of investments at risk and were the primary catalyst for the severity of the 2008 recession. Financial fraud in the lines of Enron or Bernie Madoff are other commonplace examples in financial markets. As a result, financial markets are heavily regulated and supervised and have only seen increased regulation after 2008. We will discuss regulation throughout the course in more detail, but broadly speaking, it serves two purposes. Perhaps the most important purpose is to improve information available to investors in an effort to reduce the asymmetric information problem in the first place. The Securities and Exchange Commission, for instance, forces disclosures of publicly listed firms. Banks have to file so-called bank call reports. The Federal Reserve does at least an annual exercise of so-called bank stress test, which publishes how resilient banks are to a potential economic downturn. On top of such informational activities, financial intermediaries are restricted in strong ways in the way they can be active. There are restrictions to entry, there are restrictions to the sort of disclosure public firms have to abide by, at a certain assets and activities that banks, for instance, cannot get engaged in. As an example, banks cannot hold stock. They need to provide a certain amount into insurance of depositors and so forth. The list of regulations themselves could easily fill a class. For now, I'm just going to mention it's out there. The reason why it's out there, as mentioned before, is that while financial intermediaries can benefit financial exchange and help with information, they themselves also have an informational advantage over their own providers of funds. We will discuss these concepts in more details 2 weeks from now. Before we get there, we still have to review what the concept of money is in the context of the current class, and why money is related to finance at all, which will keep us occupied in the second week.